Looking back on 2025, Canadian exports and employment in trade-sensitive sectors fared better than you might have expected. But our guest says we're not out of the woods yet. He says negative effects of these tariffs imposed by US President Donald Trump probably haven't arrived yet fully. And the collapse or a possible collapse of investment in AI is a key risk heading into the new year. Let's get more from Karl Schamotta, Chief Market Strategist at Corpay. Karl, always great to see you. Happy Monday. Thanks for joining us.
And you as well, Andy. Great to see you.
So looking back on 2025, it feels like we dodged a bullet to some extent on these tariffs. I know steel, lumber, aluminum were hit, but in general, the rest of the economy wasn't that badly damaged, it seems.
Yeah, that's right. You definitely did see a bit of a hit to exports, a little bit of employment shock in sort of your trade sensitive sectors. But when you look at the overall load on the economy, we did come through with, sort of minor scrapes and bruises. And it is sort of interesting to kind of note when you take gold exports and energy exports out of the equation, Canadian overall exports are down only 0.3%, or we're only down 0.3% for the first 9 months of the year compared with the same period in the prior year. And so, that sort of gives rise to the idea that, we did have this big sort of inventory stockpiling effort in the US and across the global economy that may have boosted our exports a bit. We might have sort of seen a front loading of the amount of goods leaving Canada. And we might still be, waiting to see a bit of a give back in that as conditions normalize, as, sort of we get to that new status quo for the global economy.
But of course, we've got to get through this trade agreement next year, and there'll be lots of heat and noise and rhetoric from President Trump. I think we can confidently predict.
Yes, that's the thing. And that's sort of where things get really challenging, especially from a foreign exchange standpoint, because when we think about where the Canadian dollar might go over the next year, if the Canadian economy is, somewhat recovering, sort of muddling through, and we see a convergence in rate policy between the Bank of Canada and the Federal Reserve, then in theory, that should give the Canadian dollar a boost. But as you mentioned there, the one thing that we definitely know here is that we are going to see some overheated rhetoric at some point. We very likely will see sell-offs in the Canadian dollar related to, whatever Mr. Trump is tweeting out next. And so, it's very much a situation where we can't really rely on any forecasts or expectations for where the currency might go.
The AI boom, do you think, Karl, some of that at least could come to a screeching halt with companies slowing down their spending plans?
Yeah, I think it's definitely a risk. Clearly investors are nervous right now. I wouldn't call this sort of a huge, high probability event, but I definitely do think that there is the possibility that investors decide that this is, vulnerability in financial markets, that they reallocate to other areas of the economy, into, the more, bricks and mortar types of businesses that generally underpin growth. And if they do that, then you could see, a compression in wealth effects. In other words, investors who and households who have, seen big gains in their balance sheets over the last couple of years related to AI, that could come down a bit, and that could that could generate a bit of a consumption crunch, right? We've had a lot of talk about K-shaped economies recently. The idea that very wealthy consumers are driving a big share of spending. If they don't feel as wealthy, then we could see a bit of a pullback there. And so, I think it's definitely something that investors should worry about over the year ahead, even if it's not, a certainty, and it's not something that they should, bet on actually occurring.
I know that spreadsheet enthusiasts are loving what AI can do for them. Karl, have you found your analysis helped by AI at all in the sense of giving you ideas or doing broad-based searches?
Absolutely. I don't think so. The challenge with what I do is that it very much does depend on the numbers being exactly correct.
Right. Yes.
I cannot, I cannot work with anything that contains anything like a hallucination or anything like that, right?
Yes.
And so far, I'm not finding that it's useful for that. However, where I do find it useful is, well, there was this economist, Tyler Cowen, who did a podcast a while back, and he was mentioning that he's always been a classical music, I guess, enthusiast,
Hmm.
and he was looking for insight, and he said, I'm going to ask the AI how to think about various compositions, right? And the AI came back with some guidance as to how to think about the problem and
Yeah.
where to go for more depth. And so what I've been using AI for so far is really how do you think about something? What's an intellectual framework to put around
Yeah.
a decision or a thought process that I want to go through. So it's helping me in that sense, but it isn't helping me in the sense of like actually processing data just yet.
No, that's right. I find the limited use I've made, it can sort of call your attention to something and then you drill into it, but needs to be checked. Well, like any information, needs to be double checked and go to the original source. Carl, give us a thought about next year economically or currency wise. Is there anything that investors are underestimating right now that could hit us between the eyes next year?
Yeah, I mean, I think the big thing to really, really put out there is that right now we're in this period of low volatility, right? We're in a period in which those tariff front-running effects are sort of obscuring any fundamental view of the economy. Financial conditions are incredibly loose,
Hmm.
liquidity is high, credit spreads are low, and this is an environment in which investors start seeking risk, right? They go out across the risk curve and they take on more leverage and bet on things that are more volatile, right? And so the issue that I see is that there are a number of surprises that could come out. I mean, we could see a reacceleration in the U.S. economy, right? If you look at a lot of the tailwinds that are behind the U.S. economy right now, they're quite powerful. We could actually see a re-rating in U.S. growth in the first quarter. We could see Fed expectations being pulled back, and that could lead to a reappraisal of where interest rates are going globally. And of course, that would spill over across virtually every asset market that you can think of. We could of course get into a situation now where you have so many governments borrowing at very high levels, at essentially wartime levels, at the same time that the big sort of hyperscalers are intensifying their borrowing activities. And so we might have a point at which investors get a little leery of all of this, and they start heading for the exits. And if that
Hmm.
happens, then we have more turbulence, and then all of that is folding into that global economy in which we're in a much more difficult geopolitical environment where we're seeing more fragmentation even within domestic economies and within domestic politics around the world. At the same time that we're having a wave of technological innovation spreading across the economy. And so all
Hmm.
that I would say here is that it's not about making linear forecasts as to what might happen in 2026. It's that right now we're in this sort of sense of calm and complacency, and that I think is underappreciating the risks that are bubbling under the surface.
Carl, thank you very much indeed, and have a wonderful 2026.
And you as well. Thank you very much.
Karl Schamotta, Chief Market Strategist at Corpay.